Today, we are opening up really a remarkable document, a window right into the center of the 2008 financial storm.
Yeah, we're looking at the March 2009 shareholder letter from JPMorgan Chase CEO Jamie Dimon.
Exactly. It's a detailed postmortem written just as the economy was, well, plunging into what Dimon himself called the sharpest, most globalized downturn since the Great Depression.
And this thing, it isn't just some dry regulatory filing. It reads almost like a survival guide. JPMC knew they had to prepare for a severe economic downturn.
So our mission today is really to unpack that playbook. What were the specific actions, the acquisitions, the risk thinking that let them navigate something they called unprecedented and virtually inconceivable?
Right, because many of their competitors just didn't make it through intact.
And there's this immediate paradox, isn't there? You see the headline numbers for 2008. JPMC earned only $6 billion. I mean, that's a huge 64% drop from the $15 billion they made in 2007.
A massive drop.
Yet the letter claims 2008 may have been one of our finest years. How does that even compute? Weak results, but a finest year.
Well, it's all about context, right? Relative to the absolute catastrophe unfolding everywhere else. They did earn $6 billion, even while taking these huge hits.
What were the main drags on the results?
Two big things marred the financials. Soaring credit costs, mostly from, consumer loans and mortgages, and then over $10 billion in write-downs within the investment bank, leverage lending, mortgage exposures, that kind of thing.
But they were still standing?
They were still standing, exactly, while others were collapsing. That's the key.
Okay, let's dig into that damage report a bit more. On the institutional side, the investment bank, the IB, actually reported a loss, right? $1.2 billion for the year.
It did report a loss, yes. But the really interesting part isn't just the loss figure, it's how it happened. Meaning their write-downs, while big at over $10 million, were actually among the lowest in the industry. And get this, their core trading businesses, things like rates and currencies, commodities, emerging markets, credit trading, they actually reported record results.
So the underlying engine was still humming.
Absolutely humming. JPMC finished #1 in basically every major league table category that year. Their fundamental, non-speculative franchise was thriving despite the chaos, or maybe even because of it in some areas.
That's a striking split. But, okay, let's turn to the retail side. That's where the systemic pain was really felt, I imagine. The CEO called it a tale of two cities.
Oh, it was severe there.
Right.
Retail financial services overall, had a poor year financially, earning about $880 million net. But if you break it down, their core retail banking business, think checking accounts, branches actually made $3 billion and grew its customer base.
So where was the disaster?
Consumer lending. Yeah. That unit reported a $2.1 billion loss. And the driver, a mind-blowing $9.5 billion jump in the provision for credit losses.
Wow.
That's a 274% increase, pure evidence of mortgages and other consumer debts going bad on a massive scale.
And this leads us, I think, straight to maybe the most revealing self-critique in the whole letter.
Yeah.
Dimon admits to a major operational mistake, calls it his worst mistake of the past several years. What was it?
It was not shutting down business originated by third-party mortgage brokers sooner. Much sooner.
The broker channel.
Yeah. He pointed out that roughly 30% of their home loans had come through that channel. And the kicker, losses on those broker-originated loans were running 2 to 3 times higher than loans they originated themselves, directly.
So was that just bad oversight, letting external standards slip? Or was it the pressure to keep up volume during the boom?
The letter suggests, competitive pressure was definitely a factor. But ultimately, it points to a failure of internal controls, letting standards slide by basically outsourcing the front door for those loans.
Did they fix it?
They did correct it by year-end 2008, pulled back to what the letter calls old-fashioned home lending standards. But they were very clear they'd be paying for this bad underwriting for years to come.
That's a heavy cost. And the only way they could even afford to pay that cost was because of their capital position, right?
Yeah.
The famous fortress balance sheet.
Absolutely critical. They went into the crisis prepared. Their Tier 1 capital, that core measure of financial strength, actually increased during 2008 from 8.4% to 10.9%.
That includes the government money, though.
It does include the TARP capital later in the year, but critically, even without that government infusion, their Tier 1 would have still been strong at 8.9%. And on top of that, they massively increased their loan loss reserves to $24 billion, bracing for more pain.
That strength, that foundation, is what allowed them to play offense when everyone else was purely defensive. Which pivots us nicely from the damage report to their strategic moves. The crisis acquisitions.
Right, the big ones. First, maybe the most dramatic, was Bear Stearns. March 2008, the government basically came knocking, asked JPMC to step in over a single weekend
To prevent a total meltdown.
to prevent a cataclysmic effect on the markets, as they put it. JPMC bought Bear Stearns for $1.5 billion, which sounds incredibly cheap for a firm that technically had $11 billion in equity on its books.
Sounds cheap, but they described it as buying a house on fire. The risk must have been enormous.
It's immense. They had to immediately take on $400 billion in Bear Stearns assets and figure out how to wind that down fast. They aimed to cut it roughly in half, down to $200 billion.
Did they get any help managing that risk?
Yes, that was crucial. The government, specifically the Fed, agreed to finance and absorb the risk on the first $30 billion of losses from a specific pool of Bear's mortgage assets. JPMC felt they could handle the rest, the most toxic bits, but they needed that government backstop to make the deal even remotely possible.
Okay, so Bear Stearns was the emergency rescue. The second big one was Washington Mutual, WAMU.
Yeah.
Even bigger scale, right? The largest bank failure in U.S. history.
That's right. Acquired in September 2008 for around $1.9 billion. And the sources say JPMC was really the only bank ready and willing to step in immediately.
Was this another salvage operation like Bear?
No, this one was different. WAMU was seen as immediately strategic. It was expected to be accretive right away.
Accretive meaning adding to JPMC's profits from day one.
Correct. They estimated it would add about $2 billion annually, plus it massively expanded their retail footprint. Suddenly, they had over 5,000 branches across 23 states. It was a huge strategic gain.
But WAMU had its own pile of bad assets, surely.
Yeah, absolutely. But they applied their conservative playbook immediately. They wrote down $31 billion of WAMU's troubled assets right off the bat, and they did it by assuming home prices would fall another 10% from the day they closed the deal, building in a huge cushion.
That discipline seems key. So, if the fortress balance sheet and that conservative approach let them survive and even thrive, let's unpack the risk management playbook itself. What specific things did JPMC avoid doing that tripped up so many others?
Yeah, the letter actually lists several specific areas where they deliberately held back. First off, they avoided sponsoring structured investment vehicles, SIVs.
SIVs. Okay. Refresh us quickly. What were those again? It's easy to forget the jargon.
Sure. Think of them as these off-balance sheet entities. They'd borrow money using very short-term debt, like commercial paper, often overnight, and use that cash to buy longer-term, often illiquid assets, like bundles of mortgages. JPMC viewed them as having, quote, plenty of risk and a limited business purpose. They'd actually sold off their only small SIV way back in 2005.
Smart move in hindsight. What else did they steer clear of?
Second big one. Toxic mortgage products, especially option ARMs, adjustable rate mortgages.
Those were notorious.
Absolutely. JPMC avoided writing them altogether. Their reasoning, they simply weren't consumer friendly. An option ARM let borrowers make payments less than the interest owed.
So the loan balance actually went up. Negative amortization.
Exactly. The loan balance grew over time. JPMC saw that as fundamentally irresponsible lending.
Okay. Avoided SIVs, avoided option ARMs. What about subprime mortgages? Everyone got burned there, didn't they?
They did take losses there, yes. But the letter states they substantially cut back on subprime early in the crisis, starting in 2006. They saw the writing on the wall.
So they minimized the damage, even if they couldn't avoid it completely.
Right. Their exposure was significantly less than firms that had really doubled down on subprime.
And finally, the really complex stuff, CDOs, collateralized debt obligations.
They deliberately avoided the highly structured end of that business, especially the infamous CDO squared.
CDO squared. That's where they packaged up slices of other CDOs, right?
Precisely. It wasn't based on actual loans anymore, just derivatives piled on derivatives. Pure, complex leverage. JPMC looked at that complexity, the layers of risk, and basically said, no thanks.
Beyond just avoiding products, the letter talks about funding discipline, how they finance their own operations.
Yeah, this is fundamental to their philosophy. It's their core financial commandment. Do not borrow short to invest long.
Meaning, don't use overnight money to fund a 30-year mortgage.
Exactly. They refuse to rely on fickle, short-term wholesale funding that could vanish in a panic. Instead, they relied on their massive, stable deposit base, getting close to $1 trillion as their safety net. Much stickier money.
Okay, speaking of funding sources, let's talk TARP, the government bailout money. JPMC took it in October 2008, but they seemed reluctant. If they were so strong, did they actually need it?
The letter is pretty blunt about this. They state clearly they felt they didn't need the capital, pointing to their strong ratios even without it.
So why take it?
Pressure. They felt pressured to accept it, to set an example for the rest of the industry, to show solidarity and encourage others to take the funds too. They believed it was the right thing to do for the U.S. financial system at that moment to stabilize confidence.
And they made a point of showing they weren't hoarding it.
Yes, they highlighted that they extended over $150 billion in new credit in just the last quarter of 2008, partly to demonstrate they were still supporting the economy.
So if JPMC managed its own risks relatively well, it really begs the question, what went so wrong with the system itself? Let's get into that analysis of the broader failures.
Right. Diamond identified multiple causes working together, which is important. It wasn't just subprime or just leverage.
It was a perfect storm.
Kind of. You had the obvious burst of a massive housing bubble, fueled by really poor underwriting, like those option ARMs we mentioned. Then you had excessive leverage absolutely everywhere. Banks, investment banks, hedge funds, even consumers.
And the regulatory framework just didn't keep up. It missed these growing structural risks.
Completely missed huge parts of it. That mismatch, Diamond talked about funding long-term illiquid assets with short-term cash. That was a systemic problem JPMC avoided internally, but it blew up elsewhere.
And the money market funds. People thought those were safe as cash.
Yeah, a $4 trillion sector that suddenly looked very vulnerable. After Lehman Brothers failed, panicked investors pulled $500 billion out of money market funds in just 2 weeks. Imagine that forced selling pressure across the markets.
The letter doesn't pull punches on the regulatory failures, does it?
Not at all. It points to major gaps. You had unregulated players like many mortgage brokers causing huge problems, and then regulated entities where the oversight failed, like insurance regulators completely missing AIG's massive one-sided bets on credit derivatives.
They were also very critical of the international banking rules, Basel II.
Extremely critical. Called Basel II highly flawed. Why? Because it allowed banks to hold less capital based on external credit ratings that turned out to be disastrously wrong.
And that directly led to more leverage.
Yes, especially for investment banks. When they adopted Basel II rules under the SEC's supervision, they dramatically increased their leverage ratios right before the crisis hit. Talk about bad timing.
But the letter reserves its strongest criticism for one specific area, calling it the largest regulatory failure of all time. What was that?
Fannie Mae and Freddie Mac, the government-sponsored mortgage giants.
Yes.
Their collapse, or near collapse requiring massive government intervention, caused enormous systemic damage precisely because they were so central to the entire U.S. housing market. Their failure highlighted a core regulatory flaw, focusing on the legal structure of a company, not the actual systemic risk it poses.
So given that diagnosis, what kind of solutions did JPMC propose back then? How do you fix a fragmented, flawed system?
They pushed for major structural reforms. First, establish a dedicated systemic risk regulator with broad authority, looking across different types of institutions and coordinated internationally.
Okay.
Second, create an orderly resolution process like the FDIC has for regular banks, but for systemically important non-bank firms. Think Bear Stearns, Lehman, AIG, a way to wind them down without causing panic.
And address that issue of regulators competing, the race to the bottom.
Exactly. Their key idea here was regulate by product and economic substance, not by legal entity. If something acts like a bank deposit and carries that kind of risk, regulate it like one no matter who offers it.
That makes sense. Any other big proposals?
Yes, a crucial one. Require originators or packagers of securitized products like mortgage-backed securities to keep some skin in the game. Retain a portion of the risk.
So they actually care about the quality of the loans they're packaging and selling.
Precisely. It aligns incentives for better underwriting from the start. And finally, fix Basel II, demand higher capital, make it less sensitive to the economic cycle, and add explicit liquidity requirements. Simplify the whole tangled mess.
Okay, as we start to wrap up this deep dive, let's look forward from that moment in early 2009. How did JPMC position itself to maintain its advantage, knowing the recession was likely to get worse?
Well, they took a pretty dramatic step, signaling their caution. They slashed their quarterly dividend from 38 cents a share down to just 5 cents.
That's a huge cut. Why?
Purely out of an abundance of caution, they said. That single move freed up about $5 billion a year in additional capital. It gave them maximum flexibility, kept the fortress strong, and positioned them to repay the TARP funds potentially faster than anyone else.
So they weren't just hoping for the best. They were actively planning for potentially worse conditions in 2009.
Oh, absolutely. Their internal planning, according to the letter, assumed charge-offs loan losses would actually be higher in 2009 than in 2008.
Really? Even after all those losses?
Yes. They specifically modeled scenarios where credit card losses could track the unemployment rate all the way up to 9%. They knew the combination of job losses and falling home prices would push defaults far beyond historical patterns.
So connecting this all back to the big picture, the letter makes this really interesting point about enormous pro-cyclical tendencies in the system. What exactly does that mean?
Procyclical essentially means the rules or behaviors make booms bigger and busts deeper. They amplify the cycle instead of dampening it.
How so?
Well, think about accounting rules or capital requirements back then. As the crisis hit and losses mounted, some rules effectively forced banks to raise more capital or shrink lending right at the worst possible moment when the economy desperately needed credit. It made the downturn worse.
So the system itself was pushing institutions toward fragility under stress.
In many ways, yes, which is why JPMC argued strongly for countercyclical measures. Things like allowing banks to build up reserves based on estimated lifetime losses on their loans.
Build the buffer before the storm hits, not during it.
Exactly. Build reserves in the good times to prepare for the inevitable bad times. It forces prudence when things feel easy.
So what does this all mean for you listening today?
Well, the core lesson JPMC was highlighting is the need to design systems, financial or otherwise, that build in resilience before a crisis. And maybe the provocative thought to leave you with, looking beyond finance now, is this.
Okay.
Think about other industries today. Where do you see strong pro-cyclical dynamics at play? Where are the rules, the incentives, or just the common practices potentially setting that industry up to amplify the pain of the next economic downturn, whatever its cause? Where might policy be encouraging fragility instead of resilience right now?
That's a really powerful question to chew on. A great place to leave it. Thank you for joining us for this deep dive into JPMC's 2008 Crisis Playbook. We hope this gives you some valuable context and maybe some new ways to think about risk and resilience in your own world.